Alright bosses, welcome back to Boss Economics World, the only channel that cuts through the noise and tells you what the spreadsheets are really saying. Grab your coffee, kill your distractions, because today we're diving into a story that's been simmering for years and has now officially boiled over, splashing hot, expensive water all over the European Central Bank. The date is September 22, 2025. And the headline that just flashed across every terminal from Wall Street to Singapore is this: France, the land of liberté, égalité, fraternité, is now officially the Eurozone's biggest fiscal train wreck. You heard me. The great European switcheroo is complete. For decades, whenever you thought of sovereign debt risk in Europe, your mind went straight to Italy, right? You'd picture spaghetti-like bond yields, chaotic governments, and a general vibe of "we'll fix the budget tomorrow." Italy was the Eurozone's resident problem child, the one you always had to keep an eye on at the party. Well, bosses, in a plot twist worthy of a Scorsese film, the problem child has cleaned up its act, gone to night school, and is now getting its credit rating upgraded by Fitch. Meanwhile, France, the chic, sophisticated, core member of the club, the one that was supposed to be the responsible adult in the room alongside Germany, has just been slapped with its second sovereign downgrade in a week. The gap is closing. Fitch now puts France just 3 measly notches above Italy. Let that sink in. The spread between French and Italian 10-year bonds, the OAT-BTP spread that was once a chasm, is now looking more like a crack in the pavement. As of this morning, it's hovering around a razor-thin 20 basis points, down from nearly 250 in the dark days of 2011. The market is screaming, in its cold, calculating language, that the risk premium for holding French debt is converging with that of Italian debt. This isn't just a bad week for Paris. This is the culmination of a 20-year disease. And today, we're going to perform the autopsy. We'll go from the surface-level symptoms, the political chaos and missed targets, all the way down to the deep, structural pathogens that have been rotting France's fiscal health from the inside out for a generation. Buckle up. So, what's the immediate trigger? Why now? The short answer is political mayhem. France's government is currently operating with the stability of a Jenga tower in an earthquake. Since President Macron's disastrous snap election gamble last year, the French parliament has been a splintered, dysfunctional mess. We're talking irreconcilable factions, the far right, the hard left, and a shattered centrist bloc all locked in a perpetual stalemate. France is now on its 5th prime minister in less than 2 years. It's a revolving door of leadership that makes Italy's old-school political chaos look like a model of Swiss efficiency. When you have no stable majority, you can't pass a budget. You can't enact meaningful reform. You can't make tough decisions. All you can do is kick the can down the road, and France has run out of road. Their deficit targets? Missed. A credible path to fiscal consolidation? Non-existent. It's like a pilot telling the passengers, "We've lost an engine and we're out of fuel, but we haven't decided where to land." Would you want to be on that plane? Of course not. And ratings agencies and bond investors are all rushing for the exits. Now, look south to Rome. Giorgia Meloni's government has been in office for almost 3 years. 3 years? In Italian politics, that's an eternity. It's like a geological epoch. And love her or hate her, that stability has allowed her government to do something shocking: govern. They've actually managed to speed up deficit reduction, pushing through fiscal measures that, while not revolutionary, are at least pointing in the right direction. This stability is the market's catnip. Investors don't necessarily care about ideology, they care about predictability. Meloni's government, despite its far-right roots, has proven to be surprisingly pragmatic on the fiscal front, working within the EU framework. France, on the other hand, is the epitome of unpredictability. The market looks at Paris and sees a 50-50 chance of either a far-right government that will blow up the budget with protectionist policies or a far-left coalition that will do the same with nationalization and unfunded spending. It's a classic pick-your-poison scenario, and investors are deciding not to drink at all. But let's be clear, bosses. This political chaos is just the symptom. The disease is far, far older. France's current troubles have been brewing since before the iPhone was invented. And the core of the disease is a simple, brutal fact: France is addicted to public spending. Let's look at the numbers, because the numbers don't lie. According to the latest OECD data, French public spending as a share of GDP stands at a staggering 58.3%. Let me repeat that. For every 10 euros of value created in the entire country, the government takes and spends almost 6 of them. This is, by a significant margin, the highest level in the entire developed world. It's higher than the famously social democratic Nordic countries. It's miles ahead of Germany, the UK, and the OECD average of 44.7%. And where does Italy stand? At 53.4%. Still high, yes, but a full 5 percentage points lower than France. This isn't a new phenomenon. Throughout the 2010s, while Italy was being forced through painful austerity by the EU and the bond markets, France was coasting. Its spending was consistently and considerably higher. When Macron was elected in 2017, he made some noise about trimming the fat, and spending did fall slightly. But then came COVID.
Both countries opened the floodgates, with Macron echoing Italy's Mario Draghi with a pledge to do whatever it costs.
But here's the kicker: after the pandemic dust settled, and after the energy crisis from the Ukraine war, Italy began the hard work of turning off the taps.
France didn't. French spending today is only marginally lower as a share of its economy than it was when Macron took office.
The temporary emergency measures have become baked into the system. This colossal state apparatus is France's pride and its poison pill. It funds a world-class healthcare system, generous pensions, and a strong social safety net. But it also creates a structural dependency that is almost impossible to reform. Every attempt to touch pensions, unemployment benefits, or the civil service is met with massive, paralyzing strikes. The French body politic has become so accustomed to the morphine of state spending that it treats any attempt at withdrawal as a mortal threat. Now, a French official might tell you, but look at the headline deficit. We're not that much worse than Italy. And for years, they were right. But the devil, as always, is in the details. Let's talk about a concept that the pros know well, but everyone should understand: the primary balance.
This is a government's budget balance before you account for interest payments on its existing debt.
It's the purest measure of a country's current fiscal discipline.
Are you taking in more than you're spending on actual services, or are you borrowing just to keep the lights on?
For years, and now once again, Italy has been running a primary surplus. This is huge. It means that if you ignore its mountain of old debt, the Italian government is actually living within its means. It's taking in more in taxes than it spends on everything from roads to schools to salaries. It is using that small surplus to slowly, painfully chip away at its debt mountain.
And France?
France has not run a meaningful primary surplus in over 20 years.
They are consistently in a primary deficit.
This means that even before paying a single euro in interest, the French state is spending more than it takes in. They are borrowing new money not just to pay for old debt, but to fund their day-to-day operations. It's the fiscal equivalent of using one credit card to pay the minimum on another, while still charging your daily lattes to a third. There's another nerdy but crucial metric called the cyclically adjusted primary balance.
Think of it as measuring a government's budget discipline during normal economic times, stripping out the effects of booms and busts. On this measure, the story is even more damning.
It shows that France's fiscal laxity is not a cyclical problem, it's a deep, structural, cultural one. This all leads to the big, scary number: public debt. Italy's debt-to-GDP ratio is still higher, hovering around 140%. But it's on a slow downward trajectory.
France's debt is now rocketing past 115% of GDP and is on a steep upward trajectory. The gap is closing at a terrifying speed because the fundamental fiscal engines in the two countries are running in opposite directions. But wait, you might say. If France spends so much, surely it must tax a lot too? And you'd be right. The French tax burden is one of the highest in the world. So how can they still be running these massive deficits? This is where the story gets really interesting, because it's a story of two opposing strategies. Under Macron, France went all in on a supply-side, pro-business agenda. He slashed corporate taxes, reformed the wealth tax, and introduced labor market flexibility. The grand plan was that these tax cuts would unleash a torrent of private investment and economic growth. This growth would, in theory, expand the tax base so much that even at lower rates, tax revenues would rise, and the debt-to-GDP ratio would shrink. It's the classic grow-your-way-out-of-debt strategy. The problem? It proved insufficient. The growth never quite materialized at the scale needed to offset the cost of the tax cuts and the perpetually high spending. The plan was a high-wire act that required perfect economic conditions, and instead, France got a pandemic, an energy crisis, and political gridlock. Meanwhile, Italy was quietly waging a different kind of war, a war on tax evasion. Using technology, Italy has made huge strides. They mandated electronic invoicing for all transactions, making it much harder for businesses to hide income. They promoted digital payments and cracked down on the cash economy. The result? A significant and sustained increase in tax compliance and revenue, without having to raise headline tax rates. So you have this perfect storm: France cut tax rates hoping for growth that didn't fully arrive, while Italy kept its rates stable but got much better at actually collecting the taxes it was owed. The Italian state's coffers benefited from quiet, technocratic competence, while France's hopes were pinned on a grand economic vision that the real world torpedoed. So, where does this leave us? The bottom line is a legacy of debt in both countries, but the momentum has completely shifted. The bond market, that great, unsentimental arbiter of reality, has taken notice. The days of France being considered a safe haven core European nation, in the same breath as Germany, are over. It is now firmly in the category of semi-core, and if this trajectory continues, it will be lumped in with the southern peripherals it once looked down upon. And here's the time bomb. The era of zero interest rates is over. All this debt has to be refinanced at much, much higher rates. France's state auditor, the Cour des Comptes, has issued a chilling warning: the annual bill for servicing France's debt is on track to skyrocket from around 30 billion euros in 2020 to over 100 billion euros by 2029. 100 billion euros. Every single year. Just for interest payments.
That will become the single largest item in the French budget, surpassing education. That is money that cannot be spent on hospitals, on the energy transition, on national defense, or on tax cuts. It is a deadweight loss, a tribute paid to the fiscal sins of the past.
This is what ratings agencies see.
They see a country with no political will to reform, a structural spending addiction, a flawed growth model, and a debt servicing bill that is about to go parabolic.
It's a toxic cocktail, and the downgrades are just the beginning. Here's the final, bitter irony. For all this spending, are the French people happy? The OECD tracks social spending as a percentage of GDP. France is at the very top, at 30.6%. Italy is not far behind at 27.6%. Yet when citizens are asked how satisfied they are with public and administrative services, both countries languish near the bottom of the rankings for developed economies. They are spending champagne money to get beer-level results, and the citizens know it. So, what does this mean for Europe? A fiscally wobbly Italy is a massive headache. But a fiscally unstable France is an existential threat to the Eurozone. France is the bloc's second largest economy. It is too big to fail, and it is absolutely too big to bail out. The Franco-German engine that powered the European project for 70 years is now running on one cylinder, and the French one is sputtering black smoke. The great European role reversal is here. While Italy is finally doing the boring, difficult work of fiscal consolidation, France is trapped in a political psychodrama, paralyzed by its addiction to a state that it can no longer afford. The question is no longer if France is the new Italy. The question is whether France's problems will be so large as to drag the entire European project down with it. Mark my words, bosses. What happens in Paris over the next 2 years will define the next 2 decades for Europe. That's all the time we have. Keep your eye on that OAT-BTP spread. It's telling you more than any politician will. Don't forget to like, subscribe, and hit that notification bell, because you know the market never sleeps. Stay sharp, bosses.